Stock splits are one of the most misunderstood concepts in investing. Many new investors get excited or worried when they hear a company is splitting its stock, but the reality is quite different from what most people think. Today, you'll learn exactly what happens during a stock split and why it doesn't actually change the value of your investment. A stock split is a corporate action where a company divides its existing shares into multiple new shares. The main purpose is to increase the liquidity of the stock in the market. When a stock price becomes very high, it can discourage smaller investors from buying. By splitting the stock, the company makes each share more affordable without changing the underlying value of the company. The most common types of stock splits are the 2-for-1 split and the 3-for-1 split. In a 2-for-1 split, every single share you own becomes 2 shares. In a 3-for-1 split, every single share becomes 3 shares. Companies can choose different ratios based on their goals, but these two ratios are the most frequently used in the market. Let's look at a practical example to understand how this works. Imagine you own 100 shares of a company, and each share is priced at $200. Before the split, your total investment value is 100 shares multiplied by $200 per share, which equals $20,000. Keep this number in mind as we see what happens after the split. After a 2-for-1 stock split, your 100 shares double to 200 shares. However, the price per share is cut in half from $200 to $100. When you multiply 200 shares by $100 per share, you still get $20,000. Notice that your total investment value hasn't changed at all. This is the most important principle to understand about stock splits. Your total investment value remains exactly the same before and after the split. You end up with more shares, but each share is worth proportionally less. It's like cutting a pizza into more slices. You have more slices, but the total amount of pizza hasn't changed. So why do companies bother with stock splits if they don't change the value? There are two main reasons. First, splits make shares more affordable for individual investors. A stock trading at $500 per share might intimidate small investors, but at $100 it feels more accessible. Second, lower prices typically increase trading liquidity, meaning more people buy and sell the stock, which companies generally view as positive. Remember, stock splits are essentially cosmetic changes. They don't affect the fundamental value of your investment or the company's market capitalization. When you hear about a stock split, understand that it's simply a way to adjust the share price and quantity while keeping your ownership percentage and total value identical. Don't let stock splits influence your investment decisions. Focus instead on the company's actual performance and fundamentals.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.